Mirko Mikelic, Senior Portfolio Manager at Fifth Third Asset Management, which has $14 billion in fixed income assets. Mirko joins us now from Grand Rapids, Michigan, with a little more insight. Mirko, great to see you. So in a lot of cases lately, thanks, two-year treasuries yielding more than corporates of the same maturity. So does this suggest investors are more confident in corporate America, or they're more concerned about America?
Well, first of all, we believe that corporates are going to outperform this year, we at FTAM. Having said that, there's some technical issues on the short end. So I did look at that, Berkshire Hathaway two-year bond versus U.S. Treasury, and now it's even, 6 basis points tighter. So there's a high demand for non-U.S. securities on the short end, and there are some risks in terms of treasuries going forward.
So another fixed income strategist told us that this is exceedingly rare, this trend. So what's your take on how unusual it is?
It is unusual. However, after what happened in 2008, nothing surprises me anymore. Berkshire Hathaway is obviously a well-run company with a tremendous amount of cash on its balance sheet. And the United States has taken an extraordinary amount of fiscal and monetary measures to not only prop the world financial system, but also different sectors of the U.S. economy. Healthcare being one.
Mirko, do you think that in the long run that investors are going to get out of the way of this?
In the long run, well, we're sacrificing a lot of things in the short run, and hopefully in the long run, this will work on out. However, that's the reason there's pressure on U.S. spreads. We're becoming more and more looking like more of a Western European nation. In terms of our debt to GDP ratio, it used to be 60% in 08. Now it's 80+%. So we're taking a lot of programs on, a lot of stimulus programs, and in the end, hopefully it'll work out.
So you think this is a no-brainer for investors?
Well, we believe this year that corporate bonds will outperform treasuries for two reasons. First of all, we think carry will carry the day. That little extra yield, notwithstanding the issues on the short term of the market, that'll help outperform this year. And secondly, in terms of what all that the U.S. government has on its plate, like we mentioned, both on a fiscal and monetary basis. And end of this year, maybe early next year, Fed is going to start raising rates. So that's going to be putting even more additional pressure on U.S. treasuries.
So really, to zero in on this theme, as you know, the Treasuries auction, the figure here is astounding: $2.59 trillion in debt since the start of 2009. Again, a tremendous amount. So really, that's the question that we're trying to get answered with you, Mirko. Is the U.S. going to be good for this amount of debt out there? Do we need to really be concerned that we're going the way of Greece?
Everyone should be concerned. I mean, there's going to be another $2.5 trillion this year. That's gross. On a net basis, another $1.4 trillion is estimated that's going to be printed. Basically, we're starting up the printing press to pay for a lot of these programs that we are undertaking and embarking on. And, the United States is doing that at its peril. This is what I'm talking about, short-term versus the long-term issues.
Right. So do you think the U.S. should lose its AAA credit rating?
It would not surprise me in a few years, just in terms of our debt levels relative to our GDP, in terms of where we're headed. Maybe a notch downgrade would not be a complete surprise, but that's definitely where we are headed.
All right. Our thanks to Mirko Mikelic, Senior Portfolio Manager at Fifth Third Asset Management.